So let's just run the room. Michael, we can start with you. Okay. And let's just go down. We'll snake through, and then we'll go Jorge. Just kind of snake through the whole room.
The ECB, the World Economic Crisis versus the U.S. economy.
Okay. 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 Boy, there's a lot more on there. I think I'm going to come back to you guys. You think about some other things that you might not know perfectly. Otherwise, I'll give you one that I heard, and we'll see if you can give me a good definition for it.
I heard Freddie, Fannie a lot.
Okay. Freddie, Fannie. And we might run out of stuff here, but it's a little early to run out of stuff here. Yeah.
The inversion of the yield curve.
Okay. Good. So inverted yield curve. Cratering? I don't even remember that part actually. Crater. How do you spell crater?
He was talking about.
Is it CRA?
Yeah, CRA. Yeah.
Cratering. Well, go ahead and give me a brief what you remember.
He was talking about cratering one of the larger investment banks.
Oh, maybe it was somehow kind of protecting. I'm not sure on that one myself. Short and long. What was it? Range? Rates. Okay, good. Reno? Okay. Dollar undervalued. Good. Dylan? Got all that? Al? Inventory, good. We'll leave the liquidation off, but yeah. Okay. That was Henry Paulson. He, it was all tied into the bank bailouts. Is what that one ended. Liquidity, good. Economic contraction.
The U.S. price level.
Good. Okay. All right, now we another one to add, or you hit one of these? Yeah. Yeah, these were a couple of ones that I thought was fair that we should have probably had on the board. This is almost like a pre-test, post-test in a way. I don't have it really designed that way, but I'm hoping at the end of the course, you should have kind of 90% of what he said figured out. Like you can actually listen to that and say, oh yeah, okay, yep, I got it. And just kind of get the information and go. So that's the type of thing that we'll be covering in class. And so other thoughts or comments on the video?
Talk about the Treasury Market.
Treasury? Yeah, that's a big one, yeah. Treasury Market. Yeah,
That guy that they quoted with the video, they said he worked for PIMCO.
PIMCO. I think that's a private, I think it's actually PIMCO, PIM Company. I think it's just a private firm. I can't remember exactly what PIMCO is myself, but it's a private company of some sort.
The medicine wasn't medicine that he was developing.
Yeah, okay, so the medicine, right, that type of talk on how are we correcting things, healing things, right? Okay, so double dip. Let me just kind of take a couple of these, maybe make a few comments. I already told you I don't have all the answers to these. Double dip. Anybody want to take a stab at what that double dip part was? Kaden?
In the business cycle, when you are coming out of recession, he was talking about if they went right back into a recession.
Okay, good. So after we have gone into recession, which is they've kind of modified definitions over time, but the standard definition was a 2-quarter decline in real GDP. How long is 2 quarters? Half a year, 6 months. So a half a year decline in real GDP. So gross domestic product, the value of, that's all the income, if you will, of as it turns out to be, all the income in the nation. After that's fallen for 2 quarters, and it started an expansion, which, by the way, ties into the contraction. Economic contraction would be that recession or it's starting to fall. And then the double dip would be if we've started an expansion and then we dip again. So double dip on the business cycle. Okay. Yes, yes. So inventories are, you can kind of think of it as product on the shelves. So when businesses make stuff, GDP measures the dollar value of all final goods and services. We break that into consumption and investment. Remember cigarettes, so those of you who had me before, and this is some stuff we'll cover in a little bit, but C plus I plus G plus X. When it's unsold goods, it's actually inventory. So it counts on the investment side. And then once it's sold, presumably if a consumer bought it, then it kind of shifts over to the C side, so that GDP really is the same. You see what I mean? So if you buy Walmart has $100 worth of stuff on the shelves, we go to Walmart, buy $100 worth of stuff, then that $100 shifts from the I over to the C, and it changes to consumption, but it keeps it the same. So that's part of this this inventory question there. The yield curves deal with bonds and interest rates, which we'll spend a lot of time on. We got a few things that we'll cover today on that. So it is a relationship between long-term and short-term rates. So these two kind of tie together. We look at the rates that are long-term versus short-term. So let me just ask you, if you were looking to buy possibly a 6-month bond, which when you buy a bond, it's an IOU, so I'm borrowing money from somebody. If I'm purchasing the bond, I'm borrowing. What rate would be higher, a 6-month bond or a 3-year bond? The 3-year would be higher. Why?
Because it's more attractive to get the money long term for parties that are issuing those bonds.
Yeah, if you're on that side of the equation, it might be more attractive to get more money. In order to tie up somebody else's money for a longer period of time, do we have to pay them more interest? Yeah, because we're tying it up for longer. And so that adds an element of risk. So you can imagine if we're talking about a corporate bond of a company, and it's like, yeah, I'll loan you some money for 6 months, but 3 years, wait a second here. You're going to have to pay me, man. I got other things, so there's the time value of money kind of kicks in. Now that's where this one ties in here. There are points in time in history where the yield curve's inverted. So if we were to look at the yield curve, it looks something like this, where this is the interest rate, this is the length of term, a 3-month bond, a 3-year bond. Well, in a couple weird circumstances, this is the way it generally looks, and then we'll go through examples where this flattens or gets steeper and the yield curve kind of changes over time. But there are a few points in time where it's looked like this. And that's usually pointing towards a recession is kind of the short of the story, that the yield curve's inverted. People are putting a preference on longer term. So that's one thing, and I think that's what Wayne mentioned in his video, was that the yield curve was far from being inverted or something like that. European Central Bank, the ECB, so they have a Federal Reserve type central bank that they deal with. Now that they've merged currencies, Germany is one of the big players, so Germany was mentioned there as a potential to bail out. He was absolutely right. That's ended up what did happen. The Germans did bail out a number of the ECU countries. World and U.S. economy we'll talk about, just kind of the interaction and when we get into the marketplaces. Freddie and Fannie are quasi-government agencies that have kind of bounced back and forth from being more heavily regulated to being kind of government out of the way. And so we call them a quasi-government agency. They insure loans for home borrowers has been their primary bread and butter. So back in the day, part of what led to the crisis, I think, was just too easy of money. And so people were getting 100% loans. Well, how'd they do that? Well, if they were backed by Fannie Mae, then the bank was insulated up to 20%. The government guaranteed, so if they bought a $100,000 house, the people didn't put any of their money down, right? The government said, hey, Mr. Banker or Mrs. Banker, I will insure this loan up to only 20% of the loan, not the whole loan, because the point would be that hopefully they can liquidate it. So the borrower goes under, we evict the people, the house is now, the housing price has dropped, and the house is only worth $85,000, and so the banker gets made up by the government the extra $15,000 that they were short on the loan. So that's the insurance policy that was provided by Fannie, and in theory, the borrower paid the premium as they had the loan. But that's the business of Freddie and Fannie. When we imploded, the problem was that the $100,000 house was now worth $60,000. And even if we had a Fannie Mae loan, all of Fannie's money was out the door, and all of their models, business models that said, oh, only X% are going to fail, so if we have to make up the 20,000, that's no big deal. A few people fail, we make it up, and that's how the system works. When everybody starts failing, they don't have this 20,000 to make up. The bank doesn't have this 20,000 that they're short to dump the house on the market, and things start to multiply fast and go down. So they play an important role in the housing market. Some critics argue whether they should be in the housing market at all, if they cause more trouble than it's worth, leading to situations of people who maybe shouldn't be buying houses. So that's all kind of up for debate. I wasn't sure on the cratering part, inventory, reversing Paulson's, just what Paulson did with the bank bailouts and kind of the timing of unwinding that stuff. So liquidity is, in general, your ability to convert something into cash. Cash is usually generally the most liquid thing. So if you're a business, you hold a lot of different assets. You might have a computer, a company car, maybe you own your own building, right? These are all various assets. But also you might have a bank account with $10,000 cash in the checking account. And then you might also have a $30,000 money market account, and then another chunk of money in a one-year bond of some sort. Those are all various assets. The most liquid one is the cash in the checking account, then the money market, then the one-year bond. Maybe the computer can be dumped on eBay. The computer can still be thought of as kind of liquid, right? Then the company car can be sold also, maybe that's somewhat liquid, but not as liquid as cash. That's the idea of liquidity. Thinking about the so economic contraction we covered up here, the U.S. price. So average level of all prices. If we take all the stuff on the shelves at Walmart, we can create an index. It could be just the Walmart index, by the way, but we end up doing it for the whole nation of goods. And so we could look at the average price of all the products on the shelves at Walmart. And you can imagine in a given day, some prices are going down, some prices are going up. But what's happening to that average level of the Walmart prices? Is that going up or is it going down? If we averaged all of those, we could create an index number that maps out that average. And so that's what we do for all final goods and services in the United States in various ways. Which one's probably the most commonly used price level? The CPI, yeah. And the C is? Consumer price index. Good. All right, so, and then there's some other price indices too. Treasury markets. So the Treasury is U.S. Treasury. So the government is a pretty major borrower of funds, if you didn't know that. They do not collect enough taxes to pay for weapons of mass destruction and all the social programs and all the stuff that they do. And so in order to pay for that stuff, they have to borrow. And they do that by issuing Treasury notes or Treasury certificates. And so the word Treasury, when we talk about it, is usually less than 1 year, a maturity date of less than 1 year. So the government has multiple types of borrowing instruments, and they can be 10-year bonds, 5-year bonds, 3-year bonds, all kinds. They kind of have a portfolio of borrowing. And when we use the word Treasury, these are the short-term stuff. And a lot of companies and banks, other foreign governments keep U.S. Treasury as an asset because so far the U.S. government's been pretty good on paying back their loans. So PIMCO we talked about, and then the medicine. The medicine can vary from time to time. Let's see, were they talking about international medicine at that time? Was that with the
Better medicine.
Yeah, and I was trying to think if that was related to the. I think that was more of the ECU, possibly of. Yeah, so the medicine in that context was probably not bailing out. When do we pull the plug? Do we choose not to do it at all? So when we bail out somebody, we are giving them what they don't have, and that is this tied back to this thing, liquidity. And so here they are. Let's go back to my company example. Remember all the assets I just did? Well, as soon as that checking account runs out of 10,000 cash and the money market runs out of its 30,000 cash, and all they have is their bond requirement that would have substantial penalties for drawing on that money, or they got the computer and they got the car and they got their building, all of that stuff isn't very liquid. And so from a cash flow standpoint, if you need to make payments, if you need to pay your vendors for getting product in, or you've got other things to do for your normal business operations, when you run out of cash, you have a liquidity issue. Banks run into that problem. They don't have enough cash. Their borrowers or their depositors potentially on withdrawals in an extreme case. And so the bailout is the government saying, oh, I'll loan you some money. We usually don't give it, although sometimes that ends up happening. But it's like, I'll be last resort. Back to my business example, I will give you a line of credit for $30,000. Now, why are they going to the government? Because everybody else says, well, that would be a stupid thing to do. This company's going bankrupt. Right? So the government says, oh, I'll do it. That's the bailout part, is that we're probably doing something we shouldn't be doing. It doesn't make really good financial sense likely. There'll be arguments like for General Motors that, well, for long term, this will be good to help save U.S. automobiles, or they'll have some sort of argument. But whether that's true or not is a big, big question mark. Okay. Well, that is a nice little review. Other last comments on those things we talked about?
I was talking about U.S. dollar undervalue being more attractive.
Oh yeah, I didn't really talk about that. We had wrote that, didn't we? Oh yeah, sorry, I skipped over that.
I guess from what I had read, I thought it was opposite, that new inflation was losing value so much that people would actually, like the world market became less valuable if they would like to keep U.S. dollar.
So, yeah, when we use the term undervalued or overvalued, it's kind of like its current price, what do we think it's going to do in 1 year versus now?
Yeah.
And so when we use that terminology, we're like, right now, if we think the dollar is undervalued, do you want to buy it and hold it or sell it? Buy it and hold it, right? So if it's undervalued now, we're thinking that it's going to go back to some sort of longer run equilibrium correction in the first place. Now a lot of that's just interpretation on whoever the analyst is, and there might be disagreements. So it's kind of like Vegas in a sense, right? we sit down to the Texas Hold'em table or something else, and we're like, or maybe better yet, betting on a sporting event. The bookie is not betting. They are just facilitating two people who think there's going to be different outcomes, right? And that's kind of what's going on with the foreign exchange market and the valuation of things, is that some people think it's undervalued, some people think it's overvalued, and it kind of goes through fluctuations. And you know, they might have made a comment like that on what the dollar had been for the last 10 years. You know, it seems to be low, it seems to be undervalued compared to something. So it's always relative to something else. Okay, good. Anything else? Okay, so I'm going to kind of continue on this theme and get into a little bit of notes. Chapter 1 kind of just focuses on some terms and other things. I'm going to do just a couple PowerPoints on some graphs. And remember, all these PowerPoints are on your well, it'll be in your MyLab, but they're in Blackboard right now too. So, just to start to get the vocabulary down, we've done a little bit of that with this opener. In general, we talk about financial instruments as securities. So the securities market. Again, I'm going to jot a few things down. I might not, you guys have access to all of these, just to kind of motivate things here. So a security in the most general sense is a claim on future income. It's kind of a legal claim on future income. And a bond is a debt security. There can be different ways that you have a claim on future income. If you're a stockholder, you can have a claim to profits via your percentage ownership. With a bond, there's a fixed obligation, the debt. And the claim that you have on them usually has a couple different forms. One is the interest rate, which is the cost of borrowing. So think of the interest rate being you're renting money. It's kind of weird to think about it that way, but it's actually kind of helpful sometimes that you're renting money. Well, how much does it run me to go rent $1,000 from People's Bank this afternoon? I can go walk in there. Hey, I'd like to rent. You know, they'd think you're pretty weird. I'd like to rent $1,000 from you. What's the rental rate running? But that's what you're really doing, right? So after 1 year, if you get $1,000, they're going to say, well, we'll give you $1,000 today. You can use it, but I want you to bring it back, less wear and tear, right? Which is not too much wear and tear with the currency or the amount, with an extra $100 with it. And so then that reflects the interest rate, that the amount you pay back is the $100 on the $1,000, and you give them back their principal amount at the end. So we're renting money. Another thing that's kind of key, as we'll see, and we talked about it even with our blurbs, is the length of term. So these two things end up being pretty important with structuring a debt, the length of term, and then there's a number of other little things we'll learn about later. But with the length of term, we've got the short term. In general, again, kind of normal language is less than 1 year. And a long-term bond would be anything greater than 1 year. Then you're kind of talking about a long-term debt instrument. Is just kind of the rule of thumb. So on this graph, we see the long-term bonds, corporate bonds. How do the government bonds compare to corporate bonds in terms of interest rate? It's lower, right? Why? Why would government bonds be lower? Bear in mind, you're giving up $1,000 for a corporate bond, you're giving up $1,000 for a government bond, and the government gyps you. Less risk, perceived risk anyway, with the, and less risky. I mean, their track record's better. It's true underlying risk, and so we'll get into models down the road of kind of estimating what that risk premium is. So this is kind of what economists would call a risk premium. The difference between the government bond and the corporate bond is the premium that we're willing to pay as a consumer. We're willing to give up that amount of money to take the safer asset. And so we're getting rid of risk. So we're really paying a premium in terms of the opportunity cost of my money. I'm giving up something to do that. Now, the 3-month is kind of interesting. In general, what does that data show about the difference between the long-term government bonds and the 3-month Treasury bills?
Not much.
What's that?
They kind of follow the same line.
They follow kind of similar line, yeah. When one's going, so they seem to be positively correlated with each other. When one's going up, the other one's kind of going up. So if you see that in the graph, we kind of start to see a little bit of movement together. It's not perfect, of course, but in general, there's probably some positive correlation to it. Which one? Yeah, right here we're down pretty low. And that's what it is, by the way, today too. This is 2010, but we've been at the same spot. Okay, it swings a lot more. So yeah, we'll think about the volatility of interest rates. So that's another good observation, is that you can see this one wiggles a lot less, and this one is a little more volatile.
So in that Treasury bills worth more than the long term, is that what he was talking about?
Yep, you got it. So that was good. That was the other thing I was going to point out. So in general, we see that the blue curve is below the red curve, which is what we'd expect. That's our yield curve. That if you're going to tie up your money for a longer period of time, then that makes it a little more risky, and you're also tying it up longer. So you need to be compensated with a little bit higher interest rate. But you can see there's points in time here where we start to get that inverted. This graph doesn't do it, but a lot of times that's where we get into recession times. Anybody even know what 2001 time frame was, economy-wise? It was September 11th time frame, so that's part of it. What else was going on in the early 2000s? How about those dot-com companies? So we kind of had the dot-com bubble, and that led to a very small recession here. But again, we had an inverted yield curve. 2007, 2008, there it is again. And so that's why Wayne made that comment, is that we tend to see that in the 1980s. Look at this. Same thing here. We were in a big recessionary period, and then we started a long expansionary phase after that. Doesn't always happen, and here we're real close. I don't know if it was actually inverted or just about close, but nothing there. Okay. All right. Common stock. How does that differ with common stock from a bond? A stock, or the stock market. What's the difference between a stock and a bond?
Well, stocks are owned by companies.
Okay, companies have stocks, but who owns the stocks? the shareholders or the public. So yeah, whoever's an owner. So you actually own the company is the big thing. So common stock is a piece of paper that represents a share of ownership. So a company might initially give out 100 shares of stock, and maybe it's a small company. And so Bob's got 30%, he's got 30 shares. Tim's got 40%, so he's got 40 shares, and then another 30 to another partner. We got three ways. Well, down the road, as they start to get bigger and bigger, they might say, you know, we should sell stock, and so then that represents our ownership of the company. Okay. A lot of what this course talks about. Financial intermediaries. Financial intermediaries. Let's take a stab at that one. Financial intermediaries. Okay, brokers, good. Of a specific type of what activity that they're doing, though. So if you are an intermediary,
Aren't you kind of like a bank in between?
okay, a bank, yeah. So it's more specific to a bank. When you said broker, like a real estate broker is brokering a transaction, they are in between the buyer and the seller, but they're not a financial intermediary. So a financial intermediary is someone who is bringing together borrowers and savers, and then they're taking on some of that risk. They're kind of like an insurance policy in a sense. So it is institutions who borrow funds from people who have saved and make loans to other people. Traditionally, that's been banks. Over time, because of financial innovation, kind of our next word to put up here. Financial innovation, because we'll talk a lot about that this semester too. Financial just development of new financial products and services. Products and services. Due to financial innovation, we've allowed other types of institutions to get in the banking business, so to speak, to do that same activity. For a while, the government had regulations in place that said only banks can do that type of activity. You are breaking the law if you are taking deposits from other people and then loaning it out. But now that's opened up to pension funds, insurance companies, and other types of financial institutions are able to do that type of thing. Let's see. Let's take a look at the Dow Jones. So the Dow Jones Industrial Average, 1950 to 2011.
Did you notice on the video that at the time that he was talking, it was down at 11 grand?
Was it at that time? Yeah.
It's 17.
Yeah, so it reached a peak. Well, I guess we can look at the data here. We were at, right in this range here, 11. And then when the recession hit, well, and this is a different index. This is the Dow Jones. So there's different indices that measure stocks. So this again is referring back to common stock activity. Does anybody know that's had some other classes on the Dow Jones? Any little snippets that you heard about it? You hear it all the time, right? The Dow is up, the Dow is down. Well, what the heck's the Dow? Funny thing is, not a lot of people really know what the Dow is, even professionals. It's kind of hard to explain what that index number means. So it's the biggest companies. It's actually just like the top 30 companies. It was invented back in the 20s where they wanted to keep track of the biggest companies out there, kind of the most heavily traded, the most well-regarded American companies. And so over time, that pool of companies has changed slightly, but for the most part, it stayed very consistent. Companies like Sears were in here, and other General Motors and other big companies were in the Dow Jones Industrial Average over time. Yeah, in a sense, yeah. Yep, that's kind of the biggest, bluest stocks that are out there. Now, there's a lot of big companies even in the top 500, Fortune 500 companies. I mean, those are great companies. So this is really like a group that's kind of set aside. The problem is it doesn't necessarily convey a lot of good information. You got to look at a number of different things. So we don't just rest on what's happening with the Dow, because you're only looking at 30 companies and what they're doing in general, right? So it's just one indicator of the stock market. And you see what happened here is that this started to go up a lot in terms of its index. But again, this index number isn't really dollars. It doesn't really reflect. It's hard to map out. I just know that it's complicated. I don't know the answer myself. But it's hard. It's a complicated combination of things that go into the average. But it is restricted to those companies. And about this time, more and more companies in the 80s and 90s, companies like Apple, went on different exchanges. They would switch to instead of being on the New York Stock Exchange, they would go into the over-the-counter. It was over-the-counter at the time. NASDAQ, since its inception, was always computer-based, and that's what kind of set it apart. It wasn't the open cry, buy, you know, all the pictures that you've seen from maybe the 80s. It's getting less and less as we get more and more computerized. But people in an open pit with an outcry auction, NASDAQ was always computerized from day one. And so it tracks like 1,000 stocks. There's different stock indices that you can follow to see what they're doing. And you can invest your personal retirement funds into those index funds, they're called. All right, we won't spend a lot of time on that in this class. We'll spend more time on, for those of you who will be going on to the investment finance class, these pieces throughout the book on what a stock is, what a bond is. I mean, you kind of got to have at least a general feel for that. Okay, so financial crisis has been a word that's been thrown around a lot. So we kind of captured that here, that little scenario I gave you with the liquidity crisis. That's what causes a financial crisis, when there's just everybody's running, and what kind of companies and people have come down to hunkering down. If you kind of like, oh, I think the sky's falling, what should I do? I should grab on to as much cash as I have and hunker down and kind of rest on my hunches to make sure I'm protected, because cash is king. During a recession, cash is king, so that you know that you're not going to be able to go out and get a loan like you could when times were good. And so you got to have your own cash. Now, as people hunker down on their cash, though, they're not out there buying more inventory, buying more product, and you can see how that kind of starts to build on itself and then causes things to multiply down quicker. All right, so that's a financial crisis. I might as well just put, let me put this one up here. I actually did my undergraduate, I think it's kind of a capstone course, I can't remember exactly, but course on money as a factor of production. It's one of my few publications that I got in an economics journal. My major professor submitted it for publication, and it was money as a factor of production. And so when they say evidence suggests that money plays an important role in generating business cycles, that's kind of what I did in that paper. And I took some data from Germany or somewhere else and got a little did what some other people had done. I didn't come up with something groundbreaking, but I just kind of did a similar analysis for Germany and found that money did play a significant role in explaining some business cycles. So that's why this monetary policy stuff is important, and we will pick up there on Friday.